We are diving immediately into a very timely submission, an analysis report on Canopy Growth Corp, or CGC, with the headline Perfect Re-Entry Point Confirmed.
A bold claim.
It is. The core argument is that the recent 4.6% dip to $1.66 is a textbook re-entry, landing right on a critical support zone.
Yeah, this is strong work. It's a really compelling, contrarian angle, buying into a red day when everyone else is scared. But our job here is to push it, to help turn this from a strong analysis into a truly robust investment thesis.
And we've identified 3 key opportunities to do just that. Let's start with the first one, which is all about marrying the technicals with the fundamentals.
Right. To elevate the material from strong technical speculation to robust investment analysis, the fundamental catalysts need to be woven more tightly into the primary technical thesis.
Okay, so unpack that a bit.
Well, the report makes an excellent case for entering at 166. It highlights that support level around 160 perfectly. But when it gets to the fundamentals, things like narrowing losses, Germany, U.S. rescheduling, they feel a bit disconnected.
Like they're just bullet points.
Exactly. They feel like separate facts rather than the actual drivers for those aggressive price targets, especially that big blue sky target of $6.
I see. So the technicals tell you when to buy, but the fundamentals aren't really connected to why the price would ever get to $6? There's a logical jump there.
That's the point right there. If you want to convince a serious investor to take this kind of risk, the reward has to be believable. I mean, a quick bounce to 188 is nice, but the promise of $6 is what makes it a bold thesis.
But couldn't you argue that for a short-term technical trade, you don't really need that deep fundamental validation? You're risking 8 cents for a quick pop. Why complicate it?
Because the material itself is aimed at the bold investor. And that implies conviction that goes beyond a simple scalp trade. A sophisticated reader is going to immediately ask, well, what if the company's fundamentals are still terrible? In that case, your $1.60 floor is completely worthless.
Okay, so the fundamentals have to do 2 jobs.
2 jobs. They have to validate the floor, and they have to justify the ceiling.
So how do we actually do that? How do we integrate them?
The suggestion here is to integrate the fundamental data points directly into the risk-reward calculation. You need to use them to explicitly validate both that technical floor and justify those aggressive upside targets.
So you're talking about making direct connections. Instead of just saying narrowing losses, you'd use that specific data to show why the floor is solid.
Precisely. For instance, the report mentions narrowing net losses. Great. But go one step further. Explain why that specific financial improvement makes it less likely the $1.60 floor will fail.
Right.
Is the balance sheet stronger now than it was the last time the stock was at $1.50? If it is, then you can argue that the $1.60 level is now fundamentally stronger.
It becomes a technical level that's actually underwritten by financial facts, not just a line on a chart.
Exactly. And you do the exact same thing for the $6 target. The report mentions Germany legalization. Okay, but why is that so good for CGC specifically?
Not just that it's good for the whole sector.
Right. You need to detail Canopy's specific competitive advantage. Do they have a significant market share in Germany's medical market already? If they have 40% of the current market, you state that fact.
Because then you can show how that translates directly into revenue when the market expands.
Now you're building a real justifiable case for that higher target. I mean, we really have to consider how that evidence of narrowing losses directly supports the premise that the $1.60 floor is, structurally solid. Making those links explicit is the key.
That makes perfect sense. So if the fundamentals validate why the stock should move, the next obvious question is about execution and ensuring the trade can actually survive the reality of a stock like CGC.
Which brings us straight to volatility and risk management.
Right.
So the report must provide a more sophisticated approach to managing the stock's inherent volatility, which, to its credit, the analysis acknowledges is high, to better serve that bold investor.
Yeah, I mean, the core of the argument is this incredible risk-to-reward ratio. You buy at $1.66, you set a stop at $1.58, an 8-cent buffer. But let's really look at that stop loss.
It's the critical weakness in the plan.
The report says there's high volatility. It just saw a sharp 4.6% drop. And yet the stop is placed just 2 cents below the key support line of $1.60.
We've all been there. You get stopped out by a 2-cent wick, and then you watch the stock rally 50% without you.
It's infuriating.
And with a stock this volatile, that tight 158 stop creates an extremely high probability of being stopped out prematurely by what is just normal market noise. It completely defeats the entire re-entry premise.
So we need a smarter way to manage the risk, one that actually respects the high conviction nature of the idea, but also the reality of trading.
Absolutely. The suggestion is to offer alternative volatility-aware strategies for risk management that actually align with the thesis. The stop should signal a real breakdown of the idea, not just a bit of intraday chop.
Okay, so what would that look like in practice?
Well, for one, you could provide a mechanism for sizing the stop based on recent volatility, not a fixed 8 cents. You could, for instance, introduce the concept of the average true range, the ATR.
A common technical indicator.
Yeah, it measures how much the stock typically moves in a day. If the ATR for CGC is, say, 15 cents, then setting an 8-cent stop is basically planning to fail. The stock moves that much all the time.
So your stop needs to be outside that normal range of noise. Maybe 1.5 times the ATR below your entry, something like that.
Exactly. It gives the trade room to breathe, to handle the expected volatility, but it still enforces discipline if the structure really does break.
Is there another way? What about a strategy that lets you keep a tight stop, but reduces the initial risk?
That brings us to a phased entry strategy. And for ideas like this, it's often a much better approach.
So you don't go all in at once.
No. You suggest buying a small, sort of exploratory position at $1.66. But you reserve the majority of your capital for a second confirming buy.
So you wait to see if the 1.60 level is tested and actually holds.
Yes. If it rejects that level and bounces, that's your confirmation. That's when you add the rest of your position. You commit the minimum amount of capital to the highest risk zone.
And you reduce the chance of getting stopped out prematurely. That's much smarter.
You know, I wonder if focusing so much on that tight $158 stop overlooks how these volatile stocks actually trade. They often dip just below support to shake people out before the real move.
To trap the smart money, the report wants you to emulate.
Exactly. You need to build that awareness into the trade construction itself. A phased entry or an ATR-based stop does that beautifully.
That's a really sharp point on the execution, and it actually leads perfectly into our final point, which is about the language, about maintaining that sophisticated, authoritative voice all the way through to the end.
Right. The final phase of the analysis needs to maintain the established analytical authority instead of shifting to overly promotional or tribalized language.
This is such a classic pitfall. I see it all the time. You build this incredible, credible case using charts, data, risk-reward calcs. Everything is very objective and very buttoned up.
It establishes this high energy, but still very analytical tone.
And then all that hard-won credibility sort of gets compromised at the end when the verdict is a screaming buy signal for the bold.
And the call to action is comment CGC Army below if you're holding strong.
Yeah, and that shift in tone can really alienate the exact person you were trying to reach with all that data. The sophisticated investor who's interested in robust analysis, not hype.
The goal, clearly, is to energize the analysis and drive engagement, and that's fine, but we can do it without losing that technical gravity.
So how do you thread that needle?
The suggestion is to frame the verdict and the call to action in a way that encourages deeper analytical engagement. It needs to maintain that calculated, authoritative voice right to the finish line.
So practically, instead of a screaming buy signal, what does a strong but authoritative verdict sound like?
You just rephrase it to reflect the data you've already presented. You could conclude by summarizing the key ratio. Given the confirmed technical floor and the projected 1 to 2.7 risk-to-reward ratio, targeting $2.66, the $1.66 entry presents a compelling analytical opportunity.
It's still high conviction.
It's very high conviction, but it's framed within a calculated risk framework. It keeps the authority.
I like that. And what about the call to action? How do you drive engagement without asking for a chant?
You turn it into a question about the analysis itself. Focus on the key variables. Ask something sharp like, is the $1.60 floor fundamentally sound enough to justify accepting this volatility, or does the technical noise force you to wait for more confirmation?
So you're asking for their judgment on the data.
Exactly. You're soliciting engagement by asking them to weigh the evidence you just presented, which reinforces the analytical nature of the entire report. That's how you close a really robust piece of work.
Okay. We've covered 3 pretty significant areas for strengthening what is already a very compelling analysis.